everyone, and a warm welcome to this Boutiques Connect with me, Musidi Mudise. I have the great privilege of welcoming back Gavin Wood, who is a portfolio manager at Camissa Asset Management. So, Gavin is going to be providing us an overview of their balance fund, some of the key successes around their stellar performance over the long term as a firm. So, a warm welcome here on Asset TV, Gavin.
Thank you very much, Masidi.
So, Gavin, we've had a number of opportunities to engage with you on numerous occasions about Camissa as a firm and your investment philosophy. And, amongst other things, one thing that is notable about Camissa is the Equity Alpha Fund. It has delivered stellar performance for over 21 years and has been awarded one of the top equity funds in South Africa for numerous years. How does this team stability over, say, 21 years in a fund like this enhance the integrity of your long-term track record and the fund's case?
Yeah, I think that the Equity Alpha Fund we launched in 2004, and since inception, we've pretty much been in the top 3 of equity managers in South Africa since that day. And we currently stand as the best equity manager in South Africa over those 21 years. So I think it's a great testament to our philosophy and our approach, and really clearly something is working pretty well. I think there are a number of things that are working really well. One is our investment philosophy. I think we're exploiting inefficiencies in the market that we think really are there and are exploitable and have proved over quite a long period of time to deliver outperformance for our clients. So I think that's number one. The second thing is that, as you allude to, that our team has been remarkably stable over that time. So the core of the team, obviously we were much smaller as a firm when we started, the core of the team that was present when we started this fund is still with us. So clearly it was a smaller team, but those individuals, that core of that team, are still with us today. So throughout that long period, 21 years, we have worked together and have delivered this very, very strong performance in the equity space. I think there are a number of things that enhance the ability to outperform from having worked for so long together. I think A, it's the continuity of approach. B, I think it's the trust that we have in each other we know each other really well. We know our strengths and weaknesses, and so we work really well together. So I think those are the key things that the longevity gives us. But I think the other one is a subtle point that I'd make, is just that given that we have been together for so long, for the entire track record, the fact of the matter is that we own that track record. So whereas I think people often say past performance is no guide to the future, it often is particularly no guide to the future when the personnel managing the fund are completely different to what they were when the track record was earned 10, 20 years ago. What we can say today is that the personnel are exactly the same. So we really own our track record. So I think it is somewhat of an indicator that in the future we would and should outperform.
Great stuff. And you raise on a couple of really good points around your firm's DNA and what's kind of like the key, which has been a key ingredient, I suppose, to your success. But could you elaborate on how your firm-wide asset size allows you to take meaningful positions in small caps as well? Because I'm sure that has been kind of key to your success around these meaningful wins for the past 21 years.
Yeah, so I think that's an area that we almost call our bandwidth. So it's our ability to have a wide choice of opportunities to put into our SA equity funds and the SA equity portion of our balance funds. The fact of the matter is that South African equity market is very concentrated. So the top 20 stocks make up a huge portion of the total market cap. And in fact, the top 50 stocks make up 90% of the market cap. So the reality is that when large managers are looking at their universe, just by the fact that their firm-wide SA equities in total is so large, smaller opportunities, and I'm talking about in the 3 to 10 billion rand market cap range, are impossible to have in their funds, in the large manager funds, as a meaningful position. Whereas in our funds, where the firm-wide aggressive SA equity funds is proportionally much smaller than the large managers, a smaller company can have a big, a meaningful percentage position in our portfolio. And if that company does well, it therefore can add meaningfully to performance. So, for example, a 3 billion rand company, let's say, could be quite easily, if we own 10% of the company, could quite easily be around about 1.5% in our funds. Whereas for a larger manager with 10 times the equity size, it's impossible for that position to be more than 0.1, 0.2% of funds. They'd have to own the whole company for it to get to 1% of the funds. So I've often referred to a company we like a lot, which is Spur Holdings, which is around about 3 billion in size. It's meaningful in our funds, over 1%. Whereas if large managers own the entire company, which is around about a 3 billion rand market cap company, it would only be around about what we have. So one can take that into, let's say, a 10 billion rand company. Like we have a number of those that have contributed materially to us in the past. Companies like Omnia and Datatech are around in that sort of 10 billion rand region. They are very large positions in our funds, 3-4%. Whereas for large managers, that's an impossibility. And these have been positions which have been 3, 4, 5 baggers over the last 5 or so years. So it's really, really big contributions to our performance, and it's just not replicatable by larger managers.
Yeah, thanks for that context. And I think it gives us a good segue into having a richer discussion around the Balanced Fund. Now, this fund has outperformed strongly over the long term, Gavin, but you've mentioned that this stems from positions built years prior. What lessons can you or have you drawn from that?
Yeah, I think that the last 18 months or so have been a remarkable performance across all of our funds, and that's captured most acutely in our Balanced Fund because it is really an amalgamation of our global equity, our SA equity, our SA fixed income, and it's all put together, and our asset allocation skills. So I think it's a great fund to focus in on to see which parts of our business are contributing. And the last 18 months have been a remarkable time where we really have had contributions from across the board, from all of those aspects. And as you say, the last 18 months have contributed to a long-term track record, which is right at the top, well over 10, 15 years. And the positions over the last 18 months, which have delivered so strongly, were built up prior to that. So I think that we seldom generally draw too many lessons. I think what the main lesson we draw is that our philosophy works. And this is not really a new lesson. Our philosophy works, and it really pays for us to, once we have conviction over positioning, to be patient and to wait it out. And then when the rest of the market realizes what we see, prices will react and the performance will come. So I think that's not new lessons for us, but it's just a reinforcement of our approach. So across the board, from fixed income positioning, which trundled along, not delivering us much until sort of 18 months ago, and we've had incredibly large capital gains, over 30% in the long bond area, as long bond yields have fallen by around 3%, which is really unprecedented. Our global equities have kicked massively strongly. And local equities, as we spoke about earlier, have also delivered massively over the last 18 months. But the longer term picture is an amalgamation of all of them together.
Thanks for that. And how do you manage client expectations around short-term performance, Gavin? Given knowing very well that in the industry you in, mean reversions are likely.
Yeah, I think it's a very important point to concentrate on. That I think it's natural when one looks at really strong recent performance for the markets and clients to perhaps be worried that positions will mean revert and therefore you'll underperform. But I think managing expectations for clients is really important in the sense of what we're telling clients at the moment is that clearly we don't sit on our portfolios. Our approach is to continuously be looking for mispricings, or where prices that we're able to buy or sell assets at deviate from where we think they should be, which is the valuation of the cash flows we see coming from those assets into the future. And naturally, if a share goes up a lot, we will have a whole lot less of it in our portfolios. We will sell a lot of it and redeploy those funds into different opportunities. So I think the mean reversion worry is that we're very passive and we sit on what we've got. It performs really well, and then it's going to move backwards. I think nothing could be further from the truth. Our balance fund has, and all of our funds have transformed quite materially over the last 6 months as the performance has kicked through in the shorter term, and there are many big changes. So, for example, 18 months ago we had substantially more SA equities than global equities, and we've changed that. We now have substantially more global equities than SA equities. In fact, SA equities is down in our balance funds to around about 28%, and global equities is up at about 40%. The fixed income positioning has moved materially, whereas the residual, which was mostly in South African long bonds, very long bonds, given the massive capital gains and the yields moving down and the lower expected returns going forward, we now are much more in the shorter area of the yield curve, in the sort of 6 or 7 year range, and very little in the much longer term bonds, much less. So that's changed materially. Then the asset allocation has changed substantially. So we've moved equities down from almost 75% to more like 65% in total. And then fixed income has gone up a lot, and as I say, much more in the shorter end of the yield curve. And then the final thing is that we've put on substantially more put option hedging within the portfolios. We think markets at all-time highs as they are now are potentially due a pullback, and just I think it's worth paying an insurance premium in our multi-asset class funds by taking out put option protection for downward movements. And we do that with lots of circumspection about how much we pay for that, but it's an important part of the volatility dampening and downside protection that we offer our clients in our multi-asset class funds. So I think that our balance fund has completely changed complexion from 18 months ago to now, given the massive performance. The final leg to point out is within the stock selection, within equities, the South African stock selection has changed quite materially. We've moved down in a lot of the big positions that have paid off and into newer positions that we think are new ideas, new high expected return options within South African equities. And then global has also had some reasonably strong stock selection changes. So it's a very, very different fund to what it was 18 months ago.
Yeah, you've given quite an extensive overview of that. And I'm curious, maybe just in case I missed it, are there any key themes or sectors that you have rotated into or out of within this fund in the last, say, 18 months?
Yeah, so I think that I've talked about the fixed income side, so long bonds into shorter bonds. And that's one that we were very, very long. Now we're much shorter. In the SA equity side, we were very overweight and very high in Naspers and Prosus, and that's come down substantially. It's delivered a huge amount of performance over the last year or so. So it's still our biggest position, but it's materially lower than what it was. Our PGMs and Platinum Group metal miners have also kicked in massively and delivered a huge performance. They are now much lower than what they would have been had we not sold a lot. And there are a couple of other examples where we've reduced. Where we've increased in the stock selection side, we've taken those profits that we've realized and put them into for example the retail sector. So we've got the highest exposure within our SA equities to the South African retail sector that we've had in quite a long time, given their share prices have come down quite a lot. And we've increased exposure to some of the miners like Exxaro and Glencore that have lagged and been reasonably weak. We've also increased exposure and overweight positions to industrials like MTN and a few others. So we've redeployed and changed complexion within the SA equity stock selection quite materially, as I say.
And now coming to the fund suitability, Gavin, how does this balance fund fit into the broader Camisa suite, and who is it generally best suited for?
Yeah, I think it is a Regulation 28 compliant fund. So I think that the there are many products and client needs that are met by the balanced fund. So I think it's a great solution to a lot of Regulation 28 needs. So to the extent that within an RA, for example, or the early stages of a living annuity drawdown, those are RA or pension fund solutions, umbrella funds. I think those are the sort of solutions that clients would be using it for. In essence, it's a highly active, highly aggressive, balanced fund with strong risk management. So it's aiming to outperform the competition and significantly outperform inflation. So I think it's aiming to deliver the highest possible expected returns given the Regulation 28 constraints. And so I think it's a sort of fund that'll meet, I think, a wide variety of investor needs. And I think it is a great option for investors to blend with some of the large big brands that are very pervasive in people's portfolios. So I think that in general, many investors out there, and it's just like I say this because the competitor funds are just so large. Most of the retail market, the individuals out there, are invested with a very small number of big names in the balanced fund space. And I just think that it would make a lot of sense for them to put our fund within that portfolio as part of the mix, to give them the diversification benefits and the performance benefits of having something very different, managed very differently, with a very different size possibility in terms of stock picking, and quite an aggressive orientation, but also a very long proven track record. So I think that it would be a great blending of option within the standard solutions that I think a lot of financial advisors are advising to at the moment.
Yeah, you make a very good observation around this concentration of most people who are in balanced funds tend to go for larger managers. So my last question to you, Gavin, is what one thing would you like to highlight as the case for an investor looking for a balanced fund to go for a much smaller manager like yourself? Like, what makes you stand apart in the balanced fund space? It's another way of, I suppose, framing my question.
Yeah, I think our size advantage is we're not small, we're medium sized. So we have the resources to be able to attract and retain the top talent, and we do. And so I think that's important, and have the governance and systems and risk management processes and client service processes that all the large managers would have. But just our fund size in general as a firm, as I said earlier, gives us a big selection opportunity in SA equity. So I think as our long track record, our 21-year track record shows, we are the top equity manager. Our bandwidth that we have and our choice that we have enables us to deliver significantly more return for clients within the SA equity portion. And I think that's a very, very meaningful advantage for clients when choosing a balanced fund. So I think that it's very different and with a very long proven track record and an approach that really works.
Well, that's all we have time for today, Gavin. It was so great to chat to you, and thank you very much for joining us on this Boutique Connect.
Thank you very much.